Why does the value of the Indian rupee rise and fall against the US dollar? What decides the exchange rate between two countries? In this video by Consumer Times, we explain the concept of foreign exchange rate in simple language along with the economic forces behind it. Learn how demand and supply, inflation, interest rates, imports, exports, foreign investment, and global events influence currency values and impact common people, businesses, travel, education abroad, and the Indian economy. This video is perfect for students, consumers, competitive exam preparation, and anyone interested in understanding economics and global finance. Hello and welcome to Consumer Times. Today we will talk about foreign exchange rate, also known as Forex rate or currency exchange rate, is the value of one country's currency compared to another country's currency. For example, if $1 equals 94 Indian rupees, it means that 94 rupees are needed to buy $1. Exchange rates are extremely important because they affect international trade, imports, exports, travel, foreign education, investments, fuel prices, and even inflation in a country. Every day, trillions of dollars are traded in the global foreign exchange market, making it one of the largest financial markets in the world. The foreign exchange rate mainly works on the principle of demand and supply. When the demand for a country's currency increases, its value rises. When demand falls, the currency weakens. For example, if foreign companies and investors want to invest in India, they need Indian rupees. This increases the demand for the rupee, and its value may rise. On the other hand, if India imports more goods like crude oil, electronics, or machinery, Indian importers need more US dollars to pay foreign sellers. This increases the demand for dollars and may weaken the rupee. Another important factor behind exchange rates is inflation. Countries with lower inflation usually have stronger currencies because their purchasing power remains stable. If inflation rises rapidly in a country, the value of its currency often falls because goods become more expensive and investors lose confidence. Similarly, interest rates also play a major role. Higher interest rates attract foreign investors because they can earn better returns. As foreign investment increases, demand for that country's currency rises, strengthening its exchange rate. Economic growth and political stability are also important. Investors prefer countries with stable governments, strong economic growth, and better business opportunities. Political uncertainty, wars, global crises, or economic slowdown can weaken a currency. For example, during international conflicts or financial crises, investors often move their money to safer currencies like the US dollar, which increases its value globally. Central banks such as the Reserve Bank of India also influence exchange rates. The RBI may buy or sell foreign currency in the market to stabilize the rupee. If the rupee weakens too quickly, the RBI can sell dollars from its foreign exchange reserves to control volatility. Governments and central banks monitor exchange rates carefully because sudden fluctuations can impact inflation, trade balance, and economic stability. Foreign exchange rates directly affect consumers. When the rupee weakens against the dollar, imported goods such as petrol, mobile phones, electronics, and foreign education become more expensive. Air travel and international tourism may also cost more. However, exporters may benefit because Indian products become cheaper in foreign markets, increasing exports and supporting economic growth. There are different types of exchange rate systems used across the world. In a floating exchange rate system, currency values are determined mainly by market forces of demand and supply. In a fixed exchange rate system, the government or central bank fixes the currency value against another currency like the US dollar. India follows a managed floating exchange rate system where market forces determine the value, but the RBI may intervene when necessary. In simple words, the foreign exchange rate reflects the economic health and global confidence in a country. It is influenced by trade, inflation, interest rates, investments, political conditions, and global events. Like, share, and subscribe to Consumer Times for more public awareness and consumer safety content. Moreover, understanding exchange rates helps consumers understand why prices change, why currencies fluctuate, and how global economics impacts everyday life.